The following is a presentation of TFNN. Live at TFNN, the Small Cap Roundup, with your host, Kate Stalter. Now, Kate Stalter.
Well, happy Thursday to you out there. Great to be here today. Looks like we've got our major indexes back in positive territory. Last I looked a little while ago, the NYSE indexes were showing some losses, but they're back up again. So for the bulls, very nice thing there. We have a lot to talk about on the show today. I want to kind of set the stage. If you have not heard the show, or maybe just heard bits and pieces of it, what we do here is, as the name of the show tells you, we do focus on the small cap universe. But what I like to do is really put that within the overall context of the broader equity market in general. So a lot of things to talk about today. I want to come back to a couple things that came up in Tuesday's show because they are still relevant today. We were joking a little bit on air and in the Tiger Den on Tuesday about the Dow 13,000 level and commenting on the possibility of a pullback after that, and it has pulled back a little bit. But I was thinking about it some more. You definitely, even though it's fun to joke a bit about some of the mainstream media euphoria that goes on, don't let opinion get in the way of the market facts or believe that it might be a good time to make some kind of prediction that something is happening. Definitely we have seen some pullbacks in the past couple of sessions. However, there was some lower volume, so not those heavy percentage drops and heavier trading volume that you would look for, and as those pile up, those could indicate a potential market turn to the downside. So just a little reminder about the importance of actually watching index price and volume action, similar to something that my colleague here at TFNN, Ken Shreve, is also doing, and he'll remind you about that on his show. It's a pretty simple concept, but it needs to be balanced with keeping aware. One of my favorite market authors, and someone I've had the privilege of interviewing for Money Show, is James Revshark DePore. Some of you might know of him. And he's written a couple of good columns in the last couple of days over at Real Money at TheStreet.com, and I'm also a columnist over there. Now, he's pointed out a couple of things. He wrote a column yesterday called Heed the Signals. And he noted that rallies don't fall apart all of a sudden just based on one day of selling, and that's true. And as he and many, many others have noted, including my absolutely brilliant former employer, William O'Neill, I had the privilege of working at his company for 10 years. As many market analysts over the years have observed, it takes a series of price and volume moves to cause a market rally to tank. So you might see the TV networks getting kind of hysterical about some of the news of the day, but they'll be euphoric again the next day. Plain as day. It just happens time and time again. So as Rev Shark was saying yesterday, some changes in small caps and in the precious metals, as he was tracking them, could be signaling that a reversal in the broader market could be in the works. So it's something to keep an eye on, but don't form a preset opinion that something is inevitable. That can trip you up. Now, he wrote another column today following up on that idea, and he wrote, "The problem with this game of top calling is that you can miss some very good gains if you are too early in your negativity." And that's exactly right. That's the whole notion of bringing an opinion or some kind of prognostication into it rather than tracking the market action. When I read that line that he wrote, you remember that old song from the early 90s, Whoop, there it is? I'm not going to sing it, but you remember that old song line? Anyway, that sentiment certainly does apply to Rev Shark's advice right there. So he's still eyeing some of the top performing big caps. I know a couple that he was mentioning. Of course, this is not going to be a surprise to anybody. There you go. There's Apple. So he's still taking a look at that. And he also mentioned IBM. I'm going to put IBM up here on Tiger TV on a weekly chart for you there. Now, IBM has been forming a pretty bullish price consolidation, and it actually rallied to a new high. So some nice action in this particular blue chip. You know, yield continues to be important. That's not relevant, of course, when you're looking at an Apple, but when you're looking at IBM and a lot of these other blue chips, the dividend payers. That's just something that continues to be in favor, and as more and more of the baby boomers are in retirement age and looking for the income, the dividend, the yield really does seem like it's something that's going to continue to be very much in favor and in attention, in the media's attention for quite some time. So maybe, as Rev Shark was noting in the article, maybe we'll rotate out of some small caps, which is fine, and I'll be talking about some of that rotation as necessary in the weeks and months as this show goes on, and how to work the timing on the buys and sells of these discretionary trades. And, you know, I treat this much more as swing trading, not day trading, absolutely not, and not really investing either, because these are not the kind of long-term holds that you would consider a typical investment. This is really more swing trading. So to kind of follow up on that topic of how to handle some of these trades, I want to follow up on something else that we talked about the other day, and that's this stock right over here. Let me pull up the ticker here, Dealer Track, TRAK. And you're looking at this on a weekly chart right here. Now, this is a stock that I've been watching. I mentioned it on the show a couple times. I think Basil actually mentioned it in his show the other day as well, noting that I had brought it up. And it illustrates a point about handling some of these thin stocks once you do own them, and with some of these smaller caps. Now, the company earlier this week, it issued a disappointing revenue outlook, even though it did beat views in its report. Now, that outlook sent the stock tumbling by about 9.5% in Wednesday's session. So I have a few points to make about that. Most importantly, the earnings dates are just huge for these smaller, thinner companies in particular. And actually, Dealer Track trades about 300,000 shares a day, so it's got some decent liquidity for a small cap stock. But nonetheless, that is pretty much on the thin side when you are comparing it to some of these blue chip names that we were talking about just a few minutes ago. So, you know, you even see some of these big caps get slammed when there are disappointing elements in their earnings report. Let me just show you a couple from just this week that you may have seen. There's Dell. I'll pull that up on a daily chart so you can see what happened to Dell after, I believe they had a disappointing revenue outlook, and the same thing happened last night. HPQ, Hewlett-Packard, reported, and the same thing, some disappointment there. And I have been seeing Meg Whitman on TV today, the relatively new CEO, urging some patience. And I think there's been quite a bit of damage done in that company over the last few years. So she and her team do have a tough job ahead of them. But nonetheless, setting all that aside, just looking at the technical action here, just that you do see even some of these larger cap companies that do get smacked down when there's some disappointment in the earnings report. So you have to be especially careful with these smaller names. Therefore, when you hold these single stocks that you're swing trading, not day trading or investing in, you know, a lot of cases, particularly lately, you probably don't have months and months and months of gains and a big cushion in a stock, so it's best to sell ahead of earnings. Now, looking at this chart here for Dealer Track, this probably, if you're looking there on Tiger TV and you see where I'm indicating here, this big up week that occurred back in the beginning of February, the stock would have offered a buy opportunity back then, so that could have been an entry point. And if you were able to hold kind of through this pullback right here, actually, let me go in here and put this back on a weekly chart. That's going to be more helpful. Okay. So that looks a little more reasonable there, doesn't it? And actually, going back to November, there was a previous buy opportunity. There could have been another one back here in February if you missed the one in November. But nonetheless, you would not have had a huge amount of gains in this particular stock either way. So selling ahead of the earnings report certainly could have been a good idea in this particular case. Now, does that mean you might forfeit some upside if there's some kind of blowout report? Absolutely. But it also means protection, as we see in this case here. And I'm very much in favor of doing these swing trades with some kind of protection in place. That's just incredibly important. So I'm always going to be reminding people about that. And when I do, we're going to be starting a newsletter here pretty soon on TFNN, focusing on the small caps. We'll be rolling that out. I don't have an exact timetable for that as of now, but it is something that's coming up. And this is exactly the kind of thing that we will be tracking in that newsletter, is when could be the buys and sells, particularly earnings dates on some of these smaller stocks. So just giving you some absolute points to look at when you might want to take your profits, cut your losses. So just something to keep in mind. We'll be rolling that out in the weeks ahead at some point. Let's see. So one other thing I wanted to show you while we're still on dealer track here. On a daily chart, let me just go back to the daily here on Tiger TV. Now, on the daily chart, obviously, that gap down was pretty horrible, okay? But if you go back to a weekly, where it kind of smooths it out a little bit, and you do see nice support right near that 10-week average. So even though that was a very harsh pullback, it actually could be the beginning of some constructive and not particularly disastrous pattern that we might be seeing that might offer a new buy opportunity at some point. So I actually kind of like this action. I still would have sold it ahead of earnings, and we can just keep watching it here for the next buy point. So let's see. I'm running out of time here in this segment. I got about a minute and a half left. I want to remind everybody of the phone number, 877-927-6648. Actually, in the next little segment would be a good time to give a call if you want to do that, because in the second half of the show, I've got another great guest who I'm really looking forward to speaking with. Randy Bateman. He is a fund manager with the Huntington Funds, and he's got a small cap fund with a terrific track record of gains and outperforming the benchmark index in recent years. So really looking forward to hearing some of his small cap ideas and his investment philosophy. Always very informative to hear from these guys. As I've said before on the show, you hear the depth of the fundamental analysis that these fund managers do. They have researchers on staff. They really dig deep and go through the numbers on the income statements, the balance sheets on all these companies. In many cases, they go visit the companies. They really know these businesses inside and out. And we can follow in their footsteps, and we can just go by the charts and see when they're buying, when they're selling, and really use their actions to determine what we're going to do. Okay, give a call, 877-927-6648. I'm Kate Stalter. This is the Small Cap Roundup.
You've always taken the long view when it comes to investing. But what if there's an opportunity right under your nose? What if you could be more responsive to market trends to seek to boost your portfolio performance right now while actually reducing your overall risk? At Direction Funds, we connect investors with alternative strategies that seek to maximize their returns, making missed opportunities a thing of the past. Smart investors deserve smart alternatives. Find yours at directionfunds.com. An investor should consider the investment objectives, risk, charges, and expenses of Direction Funds carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Funds. To obtain a prospectus or summary prospectus, please contact the Direction Funds at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. Investing in index funds may be more volatile than investing in broadly diversified funds. Distributed by Rafferty Capital Markets, LLC.
TFNN is proud to bring you the cutting edge of investment newsletters. Ken Shreve's Ultimate Growth Stocks. Ken is a top-down investor who lets price and volume in the major stock indices tell him when to be in the market and when to be out. By using his unique blend of fundamental and technical analysis, Ken will protect your hard-earned capital while realizing breakout gains. Go to TFNN.com today, click Investment Newsletters, and get Ken Shree's Ultimate Growth Stocks free for 2 weeks.
Hi, I'm Steve Rhodes, co-host of The Money Masters with Tom O'Brien, seen daily at TFNN.com, author of Mastering Probabilities, a daily investment and trading newsletter, and teacher of the money game. Studies show that 3 out of 5 people are afraid for their life in trading these markets, and the number one reason given is fear of loss. Look, fear stands for false evidence appearing real, and the money game proves it. Lesson number 1, don't risk more than 1% of your trading capital on any trade. Why, you ask? Because 35 trades in a row where you risk 50 cents and make $1 are all you need to double your trading capital, versus the 230 losing trades in a row you would need to bring your balance to $100. Let me teach you more about the money game risk-free for 30 days. Go to the homepage of TFNN.com and click on my name, Steve Rhodes, for your 30-day risk-free trial. You were born to be a money master, and I'll teach you how.
X-Story Gold Mines, an NYSE Amex-listed company trading under the symbol XG, is slated to be the newest gold-silver producer in Argentina. X-Story is forecast to produce more than $250 million in bullion annually, beginning in 2013, at a cash cost of less than $200 for each ounce of gold produced. That forecast will make X-Story one of the highest margin operators in South America and a sector leader in the mining industry. X-Story has $50 million in its treasury, having spent over $60 million to date on drilling and engineering. The ultimate size of its Argentina discovery could be determined by year-end, as results from the 6 drills operating at the site are fully assessed. To find out more about X-Story Gold Mines and their exciting growth potential, click on their banner on the front page of TFNN.com or check them out on the NYSE Amex under the symbol XG.
Here's what people are saying about Tiger TV.
Let's go to John in Tampa. Hey, John, what's going on?
Hi, Tom. How are you, sir?
I'm doing great. You having a good day out there?
A wonderful day. I love your Tiger TV. I watch it every day. I'm like a kid in a candy store.
Oh, man, I appreciate you out there watching it. How long have you been watching the Tiger TV?
I'm watching almost a month now, and it's wonderful.
It's pretty cool, isn't it?
Oh, yes, it's cool. You see the charts and everything. Thanks so much for the hard work.
Tiger TV, a great news service from TFNN.com. This segment is brought to you by BackTech Environmental. For more information, just click the BackTech banner on the front page of TFNN.com.
All right, so before the break there, we were talking a little bit about some earnings reports, particularly Dealer Track as well as HPQ and Dell, and just seeing some companies that got smacked around after not quite saying what Wall Street wanted to hear, and just how we can always take precautions ourselves as individual traders to not fall victim to that kind of action. Let's look at a couple of other earnings reports. This is Caribou Coffee, CBOU. This is a small company. I think I've talked about this one before. I've seen them in as far as I know, they're kind of in the Midwest. They're based in Minnesota. I've been in a couple of their stores in Chicago. That's the only place I've really seen them that I've been. But anyway, this has been a pretty good stock. It's rallying to some new highs today. It actually, I'm showing you a weekly chart there. Let me gap up. There we go. Let me show you the gap up there on a daily chart. So you see what happened there. Let's see. It beat on earnings and sales. It guided the full year in line, and sometimes that doesn't really garner too much of a reaction, but in this case, it did make some of the Wall Street traders happy, some of the institutional investors. Now, this is a very small company, market cap of right around the 380 million mark, maybe a little bit more today after this move up. Trades about 250,000 shares a day on average. Pretty small, pretty thin. One of those to be careful of. And of course, this is the kind of example that I'm talking about, that let's say you had been kind of holding on, you sat through this little pullback, you saw earnings were ahead. You know, if it were kind of doing this sort of action, I probably would have sold a little bit ahead of earnings, not waited until exactly the day before, that kind of thing. This is the kind of thing where you could have an opportunity to buy. I really didn't have this on any kind of watch list at all, just something that I do have on some of my IPO scans that I run here on the Telechart 2000 software that I'm showing you. But if this is the kind of thing that sometimes after a gap up, you do get the opportunity. This wasn't one of those enormous gap ups that you sometimes see. Let's see, that's about, yeah, gapped up nearly 5%. So that actually could offer you still a buy opportunity in this particular stock. Looks like Wall Street believes earnings are going to decline a bit this year. Not sure what that's about, if it's investment in the company or a revenue decline. I haven't really kind of dug too deeply into the fundamentals on this one. But and then picking up again in 2013. So there's some interesting things happening on this particular stock. Oh, and Terry is telling me that Caribou Coffee is in Charleston, South Carolina. You know, I haven't been to Charleston in many years, and that is a place I would like to go back and visit again. So Terry, maybe we can grab a coffee at a Caribou if I do make it to town. Okay, let me pull up one other here. And let's see, I've talked about this one before too. This is Storm Ruger, the gun maker. And it actually, so you see it did rally a bit and then pulled back again. This one also reported earnings recently, reversed lower. Now, if I go back to a weekly chart right over here, you see, kind of gives you a little better perspective of what's really going on. Why I like to use both daily and weekly, and also some intraday charts as well, and monthly. I really like to use a lot of different time frames when I am analyzing a stock. So this one is holding up very, very nicely around just above that 10-week moving average, so could offer a new consolidation below that previous high, could offer a new buy opportunity. So that's something else to be looking at there. This is one, let me just check here, go over to Microsoft on another screen I have here. MSN Money and Yahoo and some other sites have some terrific fundamental data, can really give you a background of what to expect. So yeah, MSN Money is saying that earnings growth expected to rise in the next couple of years, so some good signs on that one. All right. Let's see here. I've got about another minute. I want to talk to you a little bit. Let me show you a little story that I'm going to be working on for Real Money coming up later in the week, just kind of looking at some of the techs. I got interested because we had Jim Oberweis on the show on Tuesday, and he was talking about Connexa, which is this enterprise software maker, 751 million market cap, very small company. And this is one that he's invested in, that he was telling us about. And I have to say, it's kind of interesting. I mean, this would not have come to my attention at all during this steep pullback. I do like some of this price action lately, and there is some potential coming out of that enterprise software subsector of the infotech industry. So another place to keep an eye on. Okay, there's our break music. We will be back with Randy Bateman on the Small Cap Roundup.
Hi folks, this is Tom O'Brien. If you want to get great trade setups in equity as well as the option market, come over to TFNN.com and test drive my daily newsletter, Market Insights, for 2 weeks absolutely free. Each trade setup comes with a profit projection as well as stop placement. Included in Market Insights is a Twitter alert service. This allows you to take advantage of intraday setups. Volatility is back in the markets. What does that mean to you? To me, it spells short-term opportunity each and every day. The days of trending up on lighter volume are gone. We have come off the highs with volume across the globe. Don't get caught in a complacency trap. Many of the indices have given back 2 months of trading in 1 week. We have a trader's market. You can take advantage of this trader's market by test driving my daily newsletter, Market Insights, free for 2 weeks. Market Insights will give you the edge you're looking for in the markets. Go to TFNN.com, under newsletter, hit the Market Insight tab for your 2-week free test drive right here, right now.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the Rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now. In the world of financial markets, there's a new player in town with an exciting new way to trade the markets. Nadex now offers binary options as well as bull spreads in a wide range of indices along with commodity and forex markets. With as little as $100, you can gain access to a new way to trade global financial markets while guaranteeing that your risk will always be capped. Nadex allows you to multiply your trading opportunities in ways never imagined before and access markets you once thought were out of reach. With short-term trading opportunities available, including binary options expiring each hour the market is open, Nadex allows you to take advantage of a variety of market conditions regardless of volatility or market direction. Now is the time to take advantage of this exciting new market. Don't let this trading opportunity pass you by. Open your account today by clicking on the Nadex banner on the front page of TFNN.com. Nadex, a better way to trade.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Smith Barney. Simply picking the right stocks is not enough. Research has shown that choosing the right proportion of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley Smith Barney believes that a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what asset allocation and a Morgan Stanley Smith Barney financial advisor can do for you. Call Angela O'Brien, First Vice President and Certified Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Smith Barney, LLC. Member SIPC.
This segment is brought to you by Harmony Gold. For more information, just click the Harmony Gold banner on the front page of TFNN.com.
Okay, we're back after our little break there. And as those of you who've been listening to the show know, one of the things I just really enjoy doing here and bringing to you is the perspective of some of today's top small cap fund managers and analysts. Today we have a terrific guest with us. Randy Bateman is the Chief Investment Officer of Huntington Funds, as well as portfolio manager of the small cap fund, the Huntington Citus Fund. And Randy will tell me if I'm pronouncing that correctly. HSUAX is the ticker. Did I say that right, Randy?
That is correct, Citus.
Oh,
we use the term Citus because of location. That's the Latin word for location, and that's one of the criteria in looking at the investments that comprise the portfolio. Makes sense in a small cap environment, and it is something that we utilize. On top of all of our other disciplines in equity selection, we look at the geographic location to see if there's tax advantages or if there's access to markets, or if the small cap company happens to be in an area enjoying immigration into the arena, and it's made some good sense. Fund's done pretty well.
Yeah, I was just about to comment on that, actually. I was looking at the Morningstar data for the fund, and terrific track record of gains and of outperforming the S&P 500 on a 3-year, 5-year, year-to-date basis. So you said a little about it, Randy, but how are you doing this? Tell us about your investment philosophy.
Well, At the Huntington, we are a top-down shop, and so we spend an awful lot of time understanding what's going on in the economy and the big picture, taxes, international, finances, the things that you would traditionally look at if you were making those macro decisions. And in that regard, we then overlay that with where we feel different sectors will be beneficiaries of the environment that we perceive, or if they might be casualties of the environment that we're looking at out there. So that's our basic premise. It's been one of sector rotation, but as I said, we do a number of disciplines in our equity selection process that we employ across all of our fund family, and not just the Citus Fund. But there again, within the Citus Fund, we have this geographic overlay that we use that look at the physical location to see if a particular company has an advantage over its competitors. Real quickly, an example might be if you've got a company in Arizona that doesn't have any taxes, and you've got one that produces the exact same product in California that has excessive taxes. One can produce those widgets either more cheaply and sell them more cheaply, or they can keep the same price and have a higher level of profit margin. So that's kind of the premise behind how we're using that geographic overlay in the portfolio.
Now, when you were starting
in a small
out,
cap environment, it works. In a large cap, obviously, it wouldn't work. But if you go back to the original real estate, what's important in buying real estate, and it's those three things: location, location, location. So it does seem to have some applicability in the small cap arena as well.
And now, you just said something that I want to follow up on. Explain why this is something that works in a small cap strategy, but not in a large cap.
Because of the large caps now are mostly global. Where they are everywhere. Right. And so there is no real significant geographic advantage there that's being perceived. And I can give you a real quick example if you'd like. We wanted to, in our top-down philosophy, we really wanted to tap the growing middle class in China. But our expert in the international arena, Madeline Matlock, did not really want us to go into Chinese securities. So what we did was we looked at alternatives in the similar geography, and so we ended up owning a very good slug of Asia-Pacific breweries in the Citus Fund, simply because they have a direct pipeline, being in Singapore, headquartered. They have a direct pipeline to the China market that was a perfect example of what we're trying to accomplish there.
Now, Randy, one thing I was looking at on the Morningstar data were some of your top holdings, and it appears that as of the most recent reporting period anyway, at the end of 2011, it looks like your top holdings were U.S.-based. Is that still the case, or has that changed a bit?
Yeah, that's pretty much the main case. We can go up to 20% in international, but traditionally we stay at around 10% and look at those really strong names that we feel will be present and offer the investment alternatives. Now, that may expand. We may go up closer to 20% as this economy continues to slow, and we see more strength in we don't call them emerging markets, but we call them demographically favored markets, and that'd be the Indonesias, the China, India, Brazil, Poland, Australia, those countries that don't seem to have some of the burden of an aging population that Japan, United States, and many of our Western European counterparts have.
I wanted to also ask you about some of the sector weightings. I did see that technology was a big weighting, which is not surprising because you do see a lot of top-performing small caps out of the tech sector. Say a little bit about how you determine the sector weightings.
Again, that goes back to our economist, Dr. George Mokshan. His work that he did his dissertation at Duke was prefaced on trying to apply where we stand in the business cycle to those sectors that would be either outperformers or underperformers relative to the market as a whole. And so we've used his what he calls his vector auto-regression model. Now, I can only say that once a day, so we call it the VAR model, and that helps us with those application of the macroeconomic factors that we see out there together with those sectors that are going to be benefiting from that.
Then let's talk about some of the other sectors then, in addition to tech, what you're seeing right now.
We like the energy sector. I'm significantly overweight in energy and materials. We do feel that we are in a slower growing economy domestically, but there are massive amounts of opportunities in those those growth markets that are demographically favored. And as a result, we're looking at those areas that we can either export to or that have homegrown companies that we might want to invest in, and certainly the energy and materials sector are going to be something that the infrastructure of the demographically favored nations, to build that infrastructure, they're going to need the materials, and they're certainly going to need the energy, and that's why we are a bit overweight in both those two sectors. We find them as very attractive for us longer term because of this really changing demographics, aging in the West, and really strength of growth of population in the developing nations.
Mm-hmm. Now, on the other hand, I know I've talked to a number of managers, and I see that you also have a pretty decent weighting in the healthcare sector. That may be an area where aging in the Western countries could be a beneficiary.
Yeah, it sure should. We've all been kind of waiting for that. The healthcare doesn't seem to have manifested itself yet into some good performance over a longer period of time, as you would normally expect, given that. But yeah, we've got a third of our population that consists of the baby boom generation, 73 million people, and as a result of that, we know there are very few things in the economic world or the investment world that you can be absolutely sure of, but we absolutely know that we're going to have 10,000 people every day turning 65 for the next 19 years.
Right.
And if that's the case, then we have an aging population. They're going to need certain things, and how do you play that? Are they going to work longer? Are they going to need more health care, pharmaceuticals? Are they going to need more? Is there going to be a growth industry in terms of employment in the healthcare area? And then what does that do for the need for uniforms and education, and then those types of things that would help satisfy that demand that we see out there. So lots of different ways you can play it if you think about it in the big picture.
Randy, can we spend a few minutes talking a little bit about some of the holdings in the fund and tell us about some of the stocks that you do like right now and why?
Oh, sure. In the energy sector, I'll just start out there. We like OIO Geoscience. That's a company that does seismic work, almost like a miniature Schlumberger or Halliburton. We think that there's going to be a lot more drilling, and that's certainly going to be poised for opportunities there. If oil prices continue to go and Iran continues to rattle sabers, and who knows what's going to happen. The supply is always the big question mark. But we know there's going to be more drilling. And if prices go up, some of the big independent producers, maybe saddled with windfall profit taxes and whatnot, but the drillers are going to continue to do well, I think. Another one we like is carboceramics, and all this fracking that's going on, the drilling that's taking place in the Bakken field, and some of the other shale plays, they make something called proppants that are utilized in holding those little fissures open so that, nature abhors a vacuum, and if you frack those fissures and pull the gas out of them or the oil, then they're going to collapse because of the vacuum. But if you've got something that's holding that open, and that's what these proppants do, it allows more seepage, and so you get more production, and it's an efficiency thing. Carboceramics is pretty much the national leader, and I think with the opening up of China's shale production, they're going to need more of these proppants as well. So in the future, this is a long-term play that we really, really like. Another area that we have liked is farm income. Farm income was up 28% last year and 28% the previous year. And so what do farmers buy? Well, we all know they bought Deere and Caterpillar tractor, but we're looking again beyond that. And one of our largest holdings is Cabela's, because we think there'll be more discretionary income in the farmer's hands, and we think that Cabela's could be a real beneficiary of that, as will be another company that we like, which is Terra Nitrogen, a fertilizer company. We're going to be planting a lot of corn this year from the expectations of the DOA, and we know that corn uses a lot of nitrogen-based fertilizer. That's what these people do. And in the meantime, while you're waiting for the manifestation of earnings to take place, you've got an incredibly good yield. I think it's close to 8% right now at the current price.
Now, I was pulling up the charts here on Tiger TV as you were speaking, and I'm noticing quite a few of these showing some very good price action. What happened in Cabela's? Did they just report recently?
Yeah, they reported better earnings than expected, and I think our cost basis is around 18 or 20, and as of today, it's about 33.5. So it kind of settled for a good period of time in the mid-20s, but then their earnings were announced, and it looked quite good. A number of analysts then picked up coverage on the stock, and so there's been some support there, and that's accelerated here very quickly to the 33.5 mark.
Now, let me kind of just ask you a more overarching question here. At what point in terms of market cap are you looking at making a purchase? What's your definition of a small cap, Randy?
We try to stick within the S&P 600. That is, and of course that's a moving target all the time depending upon how we're doing. As you know, the small cap S&P is up about almost 11% now, and the mid cap's up almost 12%. So they've had a good run in here, so it's a moving target to a certain extent, but I like to stick with those names that are in the S&P 600 if I can.
Okay, that makes a lot of sense. Now, so what is your strategy then for taking profits? What sell signals do you use?
We are a pretty disciplined shop in the fact that we run all holdings through actually, basically every company in the country through what we call a company data sheet, and that gives us three things. There's a myriad of statistics in there, but at the end of the day, what you really want to have is a quality score. We want to have a credit score, and then we want to have a valuation score.
Okay.
And through the years, our director of research has developed this company data sheet that ultimately supplies through statistical analysis all three of those things. There's some EVA material in there. There's material we get from third parties, data that's pumped in.
Our music is cutting us off here, Randy. We've got to get going. Hey, thank you so much. I've really enjoyed having you on today. Thanks a lot.
You bet. Take care.
Bye-bye. All right, stick around. One more segment left on the Small Cap Roundup.
TFNN has an exciting announcement. As part of our Go Long America contest, Tom O'Brien and Steve Rhodes will be hosting 4 live in-person workshops that are absolutely free to attend. Denver on February 21st, Spokane on February 22nd, San Francisco on February 23rd, all from 6:30 till 9:30 in the evening, followed up by Boston on Saturday morning, March 3rd. Steve Rhodes will show you how to understand the power of 1% and how to master probability, along with avoiding getting stopped out of trades early, while Tom O'Brien will speak about the intense trading power of Tiger Gartley and butterfly patterns. All of these workshops are completely free to attend. Come see Tom O'Brien and Steve Rhodes live at one of these free workshops as part of the Go Long America Tour. For more information and to reserve your seat today, visit the front page of TFNN.com and click on the Go Long America Tour banner.
Put the power of the Chapman Wave methodology to work for you. No matter what market you trade, what time frame you trade in, or your trading style, the Opening Call, Basil Chapman's daily market newsletter, is bursting with the information and trades you need to become a more successful trader.
I've been using Basil Chapman's Chapman Wave methodology for several years now. His Chapman Wave can be used for any time period for not only equities, but futures, currencies, commodities. I've been also a subscriber of his Opening Call, which I find an invaluable tool to help me analyze the potential of the market each day. He gives you opportunities to go short and long. It includes recommendations on stocks. I strongly recommend people using the Chapman Wave, and I very, very strongly support the use of his Opening Call.
To find out more about Basil Chapman and his Chapman Wave methodology, and to get your 2-week free trial of the Opening Call, a $64 value, visit TFNN.com today.
Would you like to discover the next great tech stock? David White, TFNN's technology guru, has just launched his new newsletter, The Technology Insider. In his newsletter, David will be looking for those shining stars that may turn into the next Apple, Microsoft, or Cisco. David combines his technology background as a software programmer with his market skills as a successful professional trader to give you this unique newsletter. We're on the verge of the next great tech run. With the Technology Insider, you'll be in front of the run-up and not lagging behind. David is developing a long-term investment portfolio. Therefore, we're only offering the Technology Insider as an annual subscription with a remarkable price of only $395. That's right, for a little over $1 a day, you'll receive the fundamental technology wisdom and technical trading skills of the Technology Insider David White. What are you waiting for? Go to the front of TFNN.com, click on the link on the front page, sign up for your 2-week free trial, and become a Technology Insider today. Great Basin Gold is a mining company engaged in the exploration and development of 2 emerging gold properties in Nevada and South Africa with a total resource base of more than 23 million gold ounces. Great Basin's Burnstone mine in South Africa opened in February of this year with a resource of 20 million gold ounces, becoming the first mine to open in the historic Witwatersrand Basin in the last 30 years. The Burnstone mine is projected to have a 25-year mine life and is fully financed with production anticipated to be over 250,000 ounces per year at a cash cost of only $450 per ounce. The Hollister mine in Nevada became fully integrated in the 4th quarter of 2010 with annual production estimates of 110,000 ounces of gold per year over the 8-year mine life at a cash cost of only $527 per ounce. Great Basin Gold is cash flow positive and trades on the Toronto and New York stock exchanges under the symbol GBG.
Catch Larry Pesavento, a 40-year veteran trader. He uses pattern recognition, Gartleys, butterflies, ABCs, and Fibonacci in order to trade these markets. The Futures Hour, next on TFNN.
Back for our final segment here of the Thursday edition of the Small Cap Roundup. Always fascinating to me, and I hope to you as well, to hear from these fund managers. You know, it's funny because you do hear sometimes people might say, "Oh, well, run your portfolio like a mutual fund." No, it's for not for kind of discretionary trades like the kinds we talk about here on the more speculative or smaller cap side. There's absolutely no need for individual investors to be sitting through some of these corrections that the fund managers sit through. I mean, let me see. There's one here. I think that, okay, so here's one that Randy's fund owns, and I understand why for fund managers, they have a very different mandate that you or I would have to hold through some of these. This has a small dividend yield, I believe, about 1% or so, but it is the kind of thing that, as this begins to show some big signs of selling off, a fund manager needs to stay invested. You and I can get out of these things right away, put the money back in, buy back into this stock later on as this does become something that does start to show those gains again. But again, the fund managers have a very different mandate. Love to hear their approach, what they're supporting, why they're supporting, and frequently you really do see these things that even though they need to sit through these corrections, they do rally back and offer new opportunities for individual traders down the road. So I wanted to talk a little bit in the last few minutes today about some of the biotech. Somebody was joking around in the Tiger Den a little while ago about making a joke about staying away from these more speculative biotechs. And obviously, these are really exactly the kind of names that if you do track fundamentals, and I do, I like to look at the track record, I like to look at the earnings estimates ahead. And these speculative biotech names that not only have no earnings, but frequently they don't even have any sales, such as the case with Vivus right here, VVUS that I've put up right there. This is a small cap, market cap of about $1.8 billion. A lot of liquidity, a lot of shares moving in there today, however. Huge buying, obviously, on this particular stock on some FDA approval. And, these are the kind of names. I was reading an article, my friend Steve Burns put it on his New Trader U website. He did an interview with Chris Katcher, who I've mentioned on the show numerous times, author of the book How to Trade Like an O'Neill Disciple. And Chris has some terrific insights. And he was talking about how to get in on some of these more speculative names. And Chris normally gets into the names that have a track record of earnings growth, terrific revenue growth, but when the momentum is moving in your favor, you really don't want to be ignoring. And these biotechs, kind of like some of those infotechs back in the late 90s, watch the technical signals. They'll show you when it could be an opportune time to get in, and the charts will show you, or the timing will show you of something like an earnings report, for example, when it might be time to exit the stock. So you're not going to get surprised in most cases, many cases, by these big downside moves. Might you get smacked around a little bit in some of them? Yes, of course. There's risk to all of these. It could happen, but there are many, many proven ways to put in some safeguards for yourself when you do get into some of these names. So plenty of biotech opportunities ahead. I never sweat it if some surprise news comes out and you miss something like this one. There will always be more opportunities in that biotech pipeline and throughout all the industries. I mean, Randy kind of gave us a nice overview of the global and sector strength today. So plenty of opportunities, always something out there. So thank you for joining us, and I'll talk to you on Tuesday on the Small Cap Roundup.